Over 38 years, legendary investor Sir John Templeton maintained an astonishing 15% annual growth rate. That track record gives serious weight to what he considered the 4 most expensive words in the English language. This time, it's different. Right now, investors are performing incredible mental gymnastics to justify the sky-high prices of modern tech giants, operating under the assumption that these companies are completely immune to gravity. When investors treat any group of companies as invincible, they often ignore the underlying business math, creating a psychological blind spot that has historically appeared just before significant market shifts. We are currently watching a bubble form that mirrors a largely forgotten market collapse from half a century ago. While modern memory focuses on the dot-com bubble or the 2008 financial crisis, the crash in question targeted the world's most stable household blue-chip companies in the early 1970s. When the delusion finally broke, the entire market plunged 50%, and it took investors 8 grueling years just to get their money back. To understand the danger hiding in today's top-heavy market, we have to travel back to 1972 and conduct an autopsy on the Nifty 50 bubble. In the late 1960s, the United States was riding a post-World War II economic sugar high. Factories were booming and new suburbs were popping up overnight. The country had just beaten Germany in the war and put a man on the moon. People had money, and more importantly, they had complete, unquestioning confidence in American supremacy. That momentum bled directly into the stock market. From 1945 all the way to 1970, the market gained over 350%. This massive, decades-long rally gave birth to a new investing strategy centered around a group of massive blue-chip companies known as the Nifty 50. We're talking about giants like Coca-Cola, McDonald's, and American Express, businesses generating massive, reliable cash flow. They earned a dangerous nickname, one-decision stocks. The logic was that these companies were so dominant and so permanent, the only decision you ever had to make was to buy. When investors refuse to ever sell, the stock price detaches from reality and becomes a financial grenade with the pin already pulled. This chart shows exactly how extreme that detachment became. A normal, healthy stock market trades at a price-to-earnings, or PE ratio, of about 15. That is the baseline. But by the early 70s, the average Nifty 50 stock was trading at 42 times earnings. Household names were priced like gravity didn't exist. Coca-Cola reached 46 times earnings, Xerox hit 49, McDonald's soared to 86, and the peak of the absurdity belonged to Polaroid, which traded at a jaw-dropping 90 times its actual earnings. Looking at this pie chart, you can see the sheer concentration of capital. This small group of just 50 companies commanded roughly 45% of the total United States stock market. At that scale, people weren't buying a diversified market anymore. They were gambling heavily that a few specific price tags would simply defy the laws of math forever. Then, between 1973 and 1974, the macroeconomic dominoes started falling. Oil prices quadrupled, and strict limits were placed on consumer fuel. The crises compounded rapidly. Inflation surged to 11%, unemployment doubled from 4.5% to 9%, and President Nixon formally ended the gold standard. Reality slapped Wall Street across the face. The overall market plunged 50%, marking the worst bear market since the Great Depression. The so-called bulletproof giants got completely obliterated. Coca-Cola shares dropped over 60%, McDonald's fell 70%, and Polaroid collapsed more than 90%. The real devastation was the timeline. There was no quick V-shaped recovery. Investors were trapped in a financial purgatory, waiting 8 agonizing years just to break even, permanently killing the myth of eternal growth. Author Mark Twain famously noted that history does not repeat itself, but it does rhyme. Today's stock market undeniably rhymes with 1972. We have a new batch of one-decision stocks in the form of modern tech giants, often called the Magnificent Seven. This animated comparison highlights the alarming modern market concentration. Back in 1972, 50 companies made up 45% of the market. Today, just 7 companies carry an enormous 36% of the entire S&P 500 index. Because of that weight, every dollar put into a standard passive index fund today is placing a massive, highly concentrated bet on a handful of tech giants sustaining impossible expectations.
This chart plots the current multiples of our modern tech giants, and they look incredibly familiar.
Google and Meta trade around 28 times earnings. Microsoft sits at 38, and Nvidia commands a multiple of 50. And the extreme outlier today is Tesla, which currently trades at a massive 247 times its earnings. These are fantastic, innovative companies, but extreme structural damage is already baked into these price tags. The market is entirely top-heavy, just waiting for a few new macroeconomic dominoes to fall. As Warren Buffett points out, what we learn from history is that people do not learn from history. Staring at these valuations and whispering, "This time it's different," is a guaranteed way to repeat the disasters of the past.